Hello, this is Books of the Stock Market. How's everyone doing? As for me, I came back from my morning run and I feel nice and healthy. This entire week, the weather was really warm. It is really surprising for the temperature to be around 73 degrees Fahrenheit or 23 degrees Celsius in November, especially in the Midwest. Usually, I would need to wear 2 layers of clothes for the morning run, but this morning I ran in shorts and a t-shirt. It is also pretty bright out due to the daylight savings, and personally I'm a fan of daylight savings because I'm more of a morning person, and without it, it would pretty much be pitch black in the mornings. Anyways, let's move on to the reason why everyone is here. Last video, we learned about the head and shoulders patterns. This video, we will talk about triple tops and bottoms, also double tops and bottoms. We will first start off with triple tops and bottoms, and then move our way to double tops and bottoms. Towards the end of this video, we'll be also talking about rounding bottoms and spikes. Before we start off with the specifics, this video should be pretty straightforward if you watched our previous video on head and shoulders. There are only slight variations between triple tops and bottoms and head and shoulders, and the concepts of necklines are also similar to head and shoulders. So please watch the previous video as I put a lot of effort into explaining the important concepts of volumes and other relevant theories. I'll link that video in the comment section below. Let's start off with volume. For regular triple tops and bottoms, volume should decline after each successive peak. Once we reach the neckline and price breaks through this, volume should increase to confirm the pattern. For inverse triple tops and bottoms, volume should increase towards the completion of the pattern or when the bottoming is coming towards the end. Like regular triple tops and bottom, volume should increase once price breaks through the neckline so that it can confirm the breakout. Finally, like the head and shoulders pattern, it is not unusual for price to test the neckline again, but for both cases, this should be done on lighter volume. Before we move on to an example of triple tops and bottoms, I'd like to go over two more concepts. The first concept is where does price travel to once price breaks through the neckline? Well, that's pretty simple if you watch the head and shoulders video because it basically does the same thing. So the minimum distance will be subtracting the height of the pattern to the breakout point. The maximum distance will be reversing the entire trend. So if the stock went up during the uptrend, the stock would return to its original price before the uptrend. The second concept is that even though this is a major price pattern, they're pretty rare. However, even if triple tops and bottoms are pretty rare, they're pretty accurate, so it would be wise to keep this pattern memorized. I thought it would be pretty hard to find a triple top and bottom example due to its rarity, but fortunately I was able to find one in under 5 minutes. Here we see SPY, which is an ETF that tracks the S&P 500. Here we see the 3 peaks. The blue line that I drew represents the neckline. Does everyone remember how to draw a neckline? Well, if you don't, you just need to draw a line that connects the wicks of the first and second dip. If you observe my line carefully, not all wicks touch the neckline, but like all things in technical analysis, it is important to understand that theory and real-life situations do not always match, so you have to be flexible. Also, after this irregularity, the pattern seems to match the concepts of triple tops and bottoms pretty well. Let's now move on to volume. The black line that I drew was based on the first peak's volume. If we recall properly, volume should decrease as we move on to our next set of peaks. This is true, as we see the second peak had volume levels that never seemed to reach the black line again. The third peak did have a candlestick that had volume levels higher than the first peak, but for the majority of the time, volume has decreased relative to the first peak's volume levels. Now that we analyze volume, let's move on to the break of the neckline. Here we see the neckline break. What kind of volume levels should we see with the breaking of the neckline? We should see a huge increase in volume to confirm the movement downward. Here, we do see the significant increase in volume. Continuing with the same example, let's now calculate the price action once the neckline breaks. I first drew a green line that represents the 3 peaks of this head and shoulders pattern. I then used the ruler tool and calculated the distance from the green line to the blue line. We see that ruler tool gave us a value of $18.97. From here, we just need to subtract $18.97 from this blue line. Once again, the ruler tool was used, and this time I drew an orange line $18.95 below the blue line, which is close enough. As you can see, the price dropped below this level, but it is important to remember that the orange line represents the minimum price movement. Now that we're done with triple tops and bottoms, let's move on to double tops and bottoms. This concept is extremely similar to triple tops and bottoms. The only difference is that there are only 2 peaks instead of 3. A double top is when no higher high was made, so 2 peaks of similar heights are formed. A double bottom is when no lower low was made, so 2 troughs of similar heights are formed. If you understand the basics of uptrends and downtrends, then this price pattern should come naturally. For instance, an uptrend is defined as a trend that consists of consecutive higher highs, and a downtrend is defined as a trend that consists of consecutive lower lows. If these 2 conditions are not met for the respective trends, it signals a reversal in the trend. If you listen carefully to CNBC or Bloomberg, you can hear the words double tops and bottoms be thrown around a lot. However, most of the time, they're using it incorrectly. For a double top or bottom to form, you must see price drop below the neckline. The neckline for double tops is made by drawing a horizontal line from the dip formed between the 2 peaks. In the case of a double bottom, the neckline is formed by drawing a horizontal line from the peak that is formed between the 2 bottoms. Let's look at an example. Here we see a stock developing a price action. For now, all we know is that a new high was not formed. However, before we can call this a double top, we must wait for further price action. Waiting is important because there are 2 ways this can play out. The first way is that it is an actual double top, where the uptrend, which is represented by the purple dotted line, is broken and price moves through the neckline, represented by the blue dotted line. Price eventually drops all the way down to point C. The second scenario is that the uptrend, which is once again represented by the purple line, is not broken and the uptrend just continues. If we decided to buy shorts or sell our position based solely on the fact that peak E did not make a higher high and remained at the same level as peak D, we would have lost money. Therefore, it is important to remember to wait and see price break through the neckline. As we just saw, calling double tops and double bottoms can be a bit difficult. I'll now explain some ways that you can use to confirm a reversing trend. The first way is to make sure that price closes lower than the first peak resistance level. Intraday penetrations are not enough, and you have to see that price closes appropriately. The other way is to use the 1% or the 3% rule that we talked about in a previous video. But basically, you need to see price drop 1% or 3% below the previous resistance peak to confirm that the trend is weakening. The third way is to use a 2-day penetration rule, which is another topic that we talked about in a previous video. I'll link the video that explains the 3% rule and the 2-day penetration rule in the comment section below. But for now, this rule simply states that price needs to remain rejected by the first peak resistance level for at least 2 days. The final way, and the easiest way, is to study volume. For instance, if we see the second peak has higher volume than the first peak, it may mean that price is only consolidating and we can see a move upwards. Double tops and bottoms, triple tops and bottoms, and head and shoulders all follow the same rule of volume, so make sure you understand the rules of volume. I'll be now going over 2 final reversal price patterns that are very hard to trade and should be avoided. The first one is called rounding bottoms. This pattern is a very slow and very gradual turn from downward momentum to sideways to upward momentum. This is difficult to spot due to how long it takes to develop. For instance, they're mostly found on weekly and monthly charts. Let's look at this example. This is BMY, and we see a rounding saucer that lasted from December 2nd, 1991 to February 1st, 1996. As you can see, this pattern takes a long time to develop, and trading this type of pattern is very difficult. The second reversal pattern that is very hard to trade are called spikes. Spikes occur when the market is overextended and a sudden price-moving news causes a sudden drop. This happens very quickly and there's no real way to predict this. If this happens, you're probably losing money. So why is this pattern so hard to trade? Well, let's look at this chart below. On September 3rd, we saw a negative 4.53% move. This happened overnight and was very sudden. Up until September 3rd, we were in the overbought territory as shown in the RSI. We didn't go over RSI, but we will in the future. But for now, it is an indicator that tells overbought and oversold conditions. As the market was already overextended, we saw that news that a promising vaccine turned out not to be so promising. At that point, the market dumped and people probably lost money. Well, that's it for this video. I hope everyone learned as much as I did reading a book, as that is the whole point of this channel. In this video, we learned about different reversal patterns, such as triple tops and bottoms. The next video, we'll be moving on to continuation patterns. So if you don't want to miss out on these topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.